Welcome to my channel. We're going to look at 3 companies and I'm going to run their tickers through my discounted cash flow model. We'll also look at the financial ratios of each company. The first is Align Technology, and this company manufactures 3D scanners and makes those clear aligners for your teeth. Their market cap is $24 billion, so they're a large cap company. They're trading at $302 per share. Their free cash flow is positive and growing each year. So is their net income and their revenue. So the numbers look really good. They have no debt, which is great. 100% equity. The beta is a little under 2, so the stock is a little volatile. And their WACC is 17.53%. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows, and we estimated these numbers based off of their prior financial information. We also estimated a terminal value, which is all cash flows past year 4, and then we discounted those numbers back to today using the weighted average cost of capital, that's here in green, and we get a value of the company of $9.5 billion. If we divide that by 79 million shares, we get an intrinsic stock price of $119. They're trading at $302, so it's trading at a 152% premium. So it's definitely a strong sell according to the model. Simply Wall Street has them at $392, so they're saying the stock is undervalued. So I'm using pretty conservative numbers. You see their free cash flow is growing pretty rapidly each year, and my estimation is also growing, but my value is much lower than Simply Wall Street. Let's see where the stock has been trading at. So it's been up and down, which is why it has a pretty high beta. But it's sitting around $300 a share, so it seems like it's overvalued according to my calculation. Let's look at the ratios. They don't have a good PE, price to sales, or price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 54. So investors are paying $54 for $1 of earnings. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, there are 10. So investors are paying $10 for $1 of sales. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 18. So investors are paying $18 for $1 of book value. They do have a good current ratio and ROE. Current ratio is current assets over current liabilities, so they can easily cover their current debts and payables. ROE is net income over equity. I like to see above 20%, they're at 33%. And the best way to look at ratios is to compare them to similar companies. I've done videos on Abbott Labs and Viamed. They're both in the same industry as Align. And if Align has a number in red, they're worse than the average. If they're in green, they're better than the average. So in terms of PE, price to sales, and price to book, they're worse than the average in the industry. They have the best current ratio, ROE, and debt of the 3 companies, and they're the only company with no debt. In terms of market cap, they're in the middle at $24 billion. The next company is NextEra Energy, and this is the largest electric utility holding company by market cap. It's a big company, $138 billion, and they're trading at $281 per share. Their free cash flow is positive for 3 years, but they have a big negative in 2019, so they must have invested a lot of money that year. Free cash flow is cash flow from operations minus capital expenditures. The net income is positive every year, and it looks pretty good. Their revenue is pretty strong each year, and they had their best year in 2019 at $19 billion of revenue. They have $42 billion of debt, and they pay 5.28% interest on the debt, and their cost of debt is 4.66%. And the way you calculate that, it's the interest rate times 1 minus the effective tax rate. They have a really low beta, 0.27. The market has a beta of 1, so this stock moves much less than the market. So if you're looking for a low risk stock to hedge against the market, this is the stock you want. And their weight of equity is 46%. That means more than half of their capital structure is debt. And their weighted average cost of capital is 4.5%, which is a blend of the cost of debt and cost of equity. and that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows, that's here in blue. We also estimate a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $100 billion. If we divide that by 491 million shares, we get a calculated stock price of $205. It's trading at $281, so it's trading at a 37% premium. Simply Wall Street has them at $216 a share, so they're also saying the stock is overvalued. Stock prices have come up so much in recent months, so it's really hard to find value these days. And it looks like the stock is pretty much at its all-time high. Let's look at the financial ratios. They don't have a good PE or price to sales, and they have a decent price to book. PE is stock price over earnings per share. They're at 36. I like to see below 15. Price to sales is stock price over sales per share. They're at 7.2. I like to see below 2.5. Price to book is stock price over book value per share. I like to see below 3.5. They're at 3.7. They have a weak current ratio, a weak ROE, and a good interest coverage ratio. Current ratio is current assets over current liabilities, so they can only cover half of their current liabilities, which means they may need to take on more debt. ROE is net income over equity. I like to see above 20%. They're at 10%. Interest coverage ratio is EBIT over interest expense. I like to see above 2, and they're at 2.2. I haven't done another video with a company in this industry, so I can't compare them to anyone. The next company is Scotts Miracle-Gro, and this company manufactures and sells consumer lawn, garden, and pest control products. And they have a market cap of $9 billion, so they're a mid-cap company, and they're trading at $168 a share. So each year they have positive free cash flow and net income, which is good. That makes it a lot easier to value a company with positive numbers. And their revenue is pretty strong, $2 to $3 billion a year. They had their best year in 2019 at $3.2 billion of revenue. They have $1.7 billion of debt. They pay 6.2% interest on that debt, and the cost of debt is 4.6%. And their beta is 0.99, so the stock moves with the market. And they have 30% equity in their capital structure, which means they have 70% debt, so they're a little leveraged. And their WACC is 6.2%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimate 4 years of future free cash flows. And we also estimate a terminal value, which is all cash flows past year 4, that's $4.4 billion. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $5.2 billion. If we divide that by 56 million shares, we get a calculated stock price of $93. They're trading at $168, so they're trading at an 80% premium. So it's a sell according to the model. Simply Wall Street has them at $149, so they're also saying the stock is overvalued, just not as much as me. Let's see what the stock has been trading at. So they're also trading at an all-time high, so it's really hard to find value these days. Everything is trading at its all-time high. Let's look at the financial ratios. Their PE, price to sales, and price to book are a bit weak. Price to earnings is stock price over earnings per share, and that's 20.4. I like to see below 15. Price to sales is stock price over sales per share. They're at 3. I like to see below 2.5. Price to book is stock price over book value per share. They're at 13.1. I like to see below 3.5. They have a good current ratio, ROE, and interest coverage ratio. Current ratio is current assets over current liabilities, so they can cover their current liabilities. ROE is net income over equity, and they're at 64%, so they provide great value to their equity holders. I like to see above 20%. Interest coverage ratio is EBIT over interest expense. They're at 4.1. I like to see above 2. And the best way to look at ratios to compare them to similar companies, the only other company I did in the same industry is Nutrien. And Nutrien is better in price to earnings, price to sales, and price to book. But Scotts has a better current ratio and a much better ROE. Nutrien is much lower in debt and twice as big in market cap. So let me know what you think of the video. Leave a comment, I'll definitely answer. And if you want to see more videos of me valuing companies, then subscribe. Thanks for watching.